You kind of feel stuck in a high paying job and you're looking for a way out through financial freedom, but maybe you're considering different kinds of strategies. You're looking at real estate strategies like fixing, flipping, rentals, the BRRRR method, short term rentals, or maybe even looking at buying a franchise or even buying businesses, which is very popular right now. What is the best way to actually achieve financial freedom? That's what we're going to talk about in this video. So I remember when I had my W-2 job, I was a software engineer, software manager back in the early 2000s, and I was looking for a way to get out of what I was doing as well. I was 30 at the time, and I just couldn't envision myself working another 30 years. Even though the job was pretty good, 30 years is an awful long time. So then came along Rich Dad Poor Dad, which you probably read also, and you're like, man, I want me some financial freedom. I want to get myself some financial freedom, but it's not very, very clear on how to do it. So there's different ways to actually achieve passive income, and what I did is I flipped some houses, had some rentals, I traded some stocks and options, and I got into a franchise. I basically did everything. And some of them worked and some of them didn't. I found that really a lot of them have fundamental flaws. I'm going to talk about that here, and hopefully that will help you kind of guide you in making a better decision about what strategy to consider. And we're going to talk about real estate strategy, franchises, buying businesses, things of that nature. We're going to talk about all of that. But really, there's three things that I want you to keep in mind as you're evaluating some kind of opportunity to help you become financially free. Three things to look at, and one is how scalable is what you are wanting to do, how passive is it, and how risky. Those are the three lenses we're going to look at all these different kind of strategies through. All right, let's talk about some flips first. Very popular, right? And the thing is, most investors can only handle one flip at a time. Each flip takes about 6 months, and you can do about 2 per year, make $50,000 per flip. That's $100,000 per year, which is awesome. But how do you scale that, right? The only way you can really scale that is by working harder. If you're not buying, fixing, and selling houses, you're not making money, and that's really not passive income. So flipping isn't a very good long-term solution if you want financial freedom because it's very difficult to scale, certainly without having to work harder. And I would also argue it's also much riskier, single-family houses especially, because look at the way that single-family houses behaved in 2008, right? A lot of people lost a lot of houses. They built years and building up vast portfolios that they lost. I know a handful of people firsthand that have done that, and I don't really like a strategy in which I can lose everything. Right? I mean, yes, everything, there's a market cycle, things go down, but I don't want to I don't want to spend 5 to 10 years building something and then it literally goes away. So I'm looking for something that's lower risk and gives me a longer runway at success. But for me, flipping really isn't as scalable, and it's certainly not very passive. And so what about rentals, right? If you can get each rental the cash flow $200 per month, you need 50 rentals if you want $10,000 per month. And as you may know, managing rentals is not very passive either. Now times that by 50. So it's also not very scalable, okay? You got to work a lot harder to scale to 50 houses. So it's not very passive either. And then rentals obviously are in the single family house category. So I consider that a little higher risk as well. Plus you have, for each house, you have one tenant. If that tenant moves out, the income stops. It goes from whatever, 100% down to zero. So now you're paying the mortgage and all the expenses. So I don't like that, okay? It's not right now. For example, with a larger commercial building, you have multiple tenants in there. If one goes away, you're still cash flowing positive. That's what I mean by slightly higher risk. Short-term rentals, let's talk about that. Very popular, and the income of these used to be much higher than long-term rentals. I really liked it. I got a buddy of mine who got into it, 7 years ago, built up a sizable portfolio, a couple dozen, and was crushing it until about 3 years ago. And what was happening now in the market is a lot of markets have become oversaturated. A lot of investors got into Airbnbs and things of that nature. And now, in order to be competitive, incomes dropped. And so majority of his portfolio now is actually cash flow negative right now. He's been trying to sell it. And it's very difficult to do because the market is so saturated. So again, I don't like that too much because, again, it's more of a cyclical thing and it looks like it's run its course. Also, one of the things I didn't like about short-term rentals, even though not so much have been around for months, is new legislation, untested legislation, which, for example, you got co-living, right? The whole pad split thing. I really like that as well, pad splits. But again, it's relatively new, and not a lot of cities have passed legislation. What we saw with Airbnbs, for example, is they can get banned. New York City got banned, right? So you're buying a multi-million-dollar condo, let's say, you're going to make this kind of income. All of a sudden, boom, without you controlling any of it, you can no longer operate these short-term rentals, and that's bad. So that's legislation that is an unknown. And with more tried and true strategies have been around for a long time, the legislation has already been around for decades. It's not likely to change that dramatically. So this is why I don't like short-term rentals, because, well, the gravy train has now stopped, and same thing with pad splits. The regulation there is really not proven as well. Let's talk about some other strategies. Self-storage, maybe. You may be getting love self-storage. And I love this strategy, actually, because it is scalable, and it's one of the more recession-resistant strategy. But it's not nearly as passive as multifamily, because it's much difficult to hire professional third-party management companies. When you study self-storage investors, they struggled in the beginning trying to work with property managers and eventually only became successful when they started to self-manage. But same thing, by the way, with mobile home parks. Now, the advantage of self-storage, which mobile home parks don't have, is that you can use a lot of technology to actually bring to a lot of self-service things where you have keyless entry and you may not even need a person at all. So I do like that part of self-storage as well. But one of the reasons I don't like mobile home parks is because it is, in fact, very difficult to find third-party management. So if you want something a bit more passive, mobile home parks is really not a great way to go. However, it's very scalable, right? Because you can buy mobile home parks if you can solve the management problem. Now, let's what about online trading, options, currencies, commodities, cryptos. And as you may know, this strategy is not very passive, as any active trader will tell you. If you're not constantly watching the markets, you're not going to do very well. Now, it is scalable because you can use leverage, but it also increases the risk substantially. Even if you don't use leverage, this strategy is one of the riskier ones. In fact, trading is one of the most difficult ways to make money, with studies showing that over 97% of traders lose money over time. And while this strategy is very exciting, it's really not a great vehicle for passive income. Let's talk about buying businesses or franchises. This is a very popular strategy right now, buying business more so than franchises. And we do like this strategy better than starting a new business, right? If you buy an existing business that's already been in business, is making money, it's less risky than actually starting one from scratch. But the thing that most people don't realize is that when you buy a business, or even when you get in a franchise, someone's going to have to run that business. A lot of these businesses are really keyed in for owner-operators, right? And so that owner-operator means that you own the business or the franchise. That means you're also going to run it. So before you jump in and buy a business or you get in a franchise, what is it meant to be? In other words, does the cash flow of that franchise work for a non-owner-operated owner or not, right? So I only say that because when I got in, it was really more like that. A lot of the franchises I looked at were like that as well. Now, even if you hire someone, right, what if that person doesn't perform or leave? Who's going to step in? The answer is going to be you. And a lot of business and franchises really only work for those owner-operators like we talked about, and someone's got to step in and hire and manage that person. So it's not nearly as passive as you like. Now, then the last one is, of course, multifamily investing. And this, to me, checks all the boxes, right? It's very scalable. In other words, you can actually buy a deal and then put a property manager in place and buy another deal and put a property manager in place, which makes it also more passive, because out of all the strategies you might be looking at, this is the only one that has professional property management already built into the business model. It's very unusual for a multifamily owner to self-manage, unless maybe they're not thinking very big or they're buying small multi-units. But anything larger than a 20 unit, it typically is managed by a professional multi-manager, which means that I can scale without working harder. That's very, very important. Also, the risk, I really like the risk. It's similar, very recession resistant, like mobile home parks and self-storage as well. I like how it behaved in 2008. Even though rents were flat and vacancies were up a little bit in 2008, because the break-even point is so much higher, most multifamily owners did okay, and they just kind of got through it until it recovered again in 2009. I also like the way it performed during COVID, for example. And it just appears to be a much more recession-resistant asset class. So this is one of the reasons I like multifamily the best. So if you are considering financial freedom and you're looking at different strategies like we talked about, just take a strong look at multifamily because it checks all the boxes. Now, you might not really know how to get into multifamily right now. You're like, my gosh, Michael, I don't have the experience to get into this and I don't have the money to get into it. The good news is you can learn how to appear very experienced within 30 days, and you can actually learn how to raise capital within 30 days. It might be a shock to you. So if you want to learn more about that, then check out our Apartments 101 mini class, free training that kind of talks to both those points of how you can get started in the apartment industry and really become very proficient within a short period of time. So check it out. Hope you found this useful as you're considering different strategies to become financially free.